What's going, guys? Hope you're having an absolutely fantastic day. So on the 28th of February, I made a video talking a bit about HIMS stock and a bit about other moves that I'm making, right? So you can see that on the 28th of February, HIMS stock was around $13. So I made a video titled HIMS stock is up 100% in 6 months. Here are my next 3 moves, right? So in the video, I actually detailed what my thought process was and all, and I mentioned that I might make a breakdown on like him specifically, right? Because it was a huge position and is still a huge position in my portfolio, right? So you can see that on the 28th, I made it somewhere here. So I did mention that I was trimming, right? So I did trim somewhere here. And I think my last sell was somewhere around, I think it was 1660, right? So I'm not saying I'm a genius because I started selling at like 1330, I think. And then I sold all the way up to 1660. And my average selling price was 15, right? So turned out to be a good move. I think it was 1520 or something like that. So let's just use here. So I saved myself about 20%, right? And it's not insignificant, right? Because I shaved off about 60% of the portfolio, right? So I'm going to do a full analysis and then we'll see if HIMS is a buy right now, right? So let's start off with a slideshow that I made. So if you guys enjoy all this deep dives, do help me smash up the like button, right? So 2023 full year, right? Let's look at the results, right? So 1.5 million subs. So you can see that the total subs, right? Sorry, this is wrong actually. I changed it because I thought it was $100 billion, right? But actually it's 100 million plus users, right? Customers basically. And I think in that 100 million, there'll be a lot of cross-selling, right? So the actual number can be actually like 300 million if everyone is using one product, right? So emphasis on customized solutions, which is I think where the mode of this company is going to come from, right? Imagine you have a customized solution from your pharmacy. Would you go to another pharmacy? Because no, they're not going to have exactly what you want, right? And you know, customers, when they get exactly what they want and there's nothing hugely wrong with that product, they won't really change, right? So 85% retention rate, that is really good, right? This is like software as a service kind of retention rate, right? Obviously, there are some software companies growing higher than this, like maybe like Snowflake, CrowdStrike, all these companies, they have like 100+%, right? Means that their existing customers will buy even more next year, right? So 85% retention rate is not the best, but certainly nothing to scoff at, right? It's one of like the best kind of retention rates for this kind of businesses, right? But do bear in mind that this, because they have customized solutions and also they have a subscription model, right? So obviously 85% retention rate is still very good, right? Because after 1 year, only 15% of your customers think your service is not worth it to purchase anymore, right? Meanwhile, Netflix has 72% retention rates. And why are retention rates important, right? Because if you have a product which you constantly need to sell, right? I think everyone has heard of like the leaky bucket analysis, right? Basically, every business is a leaky bucket. The water goes in, which is your customers and your sales. And then there will be some that drop out, right? Because some just don't find your product compelling. Maybe it's not for them. Maybe your shop is too far away from them. So if you pour in water and 85% of the water is still inside of the bucket after 1 year, right? That's pretty good, right? Because as you continue pouring, there's still 85%. Maybe next year it will be 90%, hopefully. And then you can retain a lot, and then you save on your marketing costs and you save on your customer acquisition costs, right? So Netflix has 72%, right? So every year 28% of Netflix users are canceling, right? Which is quite actually surprising to me because I didn't think that many people would cancel Netflix, right? But then again, there's like 18 streaming services or something now. It's crazy. So this is something that I noticed inside the conference call. They're focusing a bit on the free cash flow already, right? And they're focusing on like where the share price is a bit, because if you take a look at the share price, right? At some point, it was trading at like $5 or $6, right? And this was like the place that I was buying. So my cost basis was 6 something, right? And why is the share price important, right? Because obviously you want a management that will respect the shareholders, right? And I'm not saying like pump the stock and all. And in fact, that's a red flag for me later, right? So it's not to pump the stock and all, but this is not necessarily a bad thing, right? Because imagine if all the companies are trading based on free cash flow, and your company is just really high growing revenue. Eventually you might catch a bid from a bigger pharma company that decides to buy you over for what you can say is pennies on the dollars, right? Maybe the growth potential of this company is 10x, but it's cut short because someone offers 2x, and then you can just buy over the company because shareholders are just itching to get out, right? So the share price must also be controlled a bit, right? So for the full year, 47 million in cash flow. What is this? Okay. 47 million in free cash flow for the full year of 2023. So I don't think that it's a far stretch for you to say that 2024 might be a year that they do 100 million, right? Because these companies that go from free cash flow negative to free cash flow positive, right? 10 in the first 2 to 3 years to have very high growth, right? And then they moderate, right? So if you take a look at a company like Amazon after the IPO, the first year after the IPO, or was it the year before the IPO, something like that, they grew like some crazy number. It's like 600, 700, 800% on their revenues, right? So it is definitely possible, right? 100% on free cash flow. So look at strong growth, still anticipated. My best guess is they will do like 30% for the next 3 years. And then after that, they might do 25% plus, right? Because you do have to remember they only capture like 1.5% of their total addressable market, right? In the US only, right? Imagine when you launch, and 1.5 million customers is including worldwide customers, right? But I think the lion's share of their business comes from the US. So I'm just going to count everything in the US for this current moment, right? But you can see that the total population on the planet is 8 billion. Maybe they're at 1.5 million. I think their total addressable market can easily be above like 500 million, right? For all Western countries and stuff like that, because we all know how annoying it is to need to go to a hospital just to get a prescription, to get a drug, to get it done again and again, right? And that's more frequent in the US. In my country, Malaysia, they are not really that strict on it. You can like walk in and get painkillers just from the pharmacy, you can just buy it like that. But I've heard in the US, you need to actually get a prescription because they have a lot of people that abuse this kind of drugs. So they layer more and more regulation, and eventually you just can't get anything done, right? Even for simple things like ED drugs or something. Last time, I think it was very complicated to get it before all these e-doctors came on the market, right? So some red flags, right? Gross margins at 83%. And this is, some people might look at this and say, that's fantastic. What do you mean red flags? But you do understand that HIMS is not adding, their edge is not really in manufacturing all these products. So some drugs and all, they just buy and then they resell. They package it and they resell, right? So I don't think you should be charging 83%, right? But normally, any company that has above a 70% gross margin, there'll be a company with a huge moat, right? So 83%, it's good in the sense that this company clearly has a moat, but I would think that this number has to come down, right? Because I don't think 83% gross margins is very value accretive to the customer, right? Even though currently they are saving the customers money, but you know customers, right? As Amazon mentioned, they always want lower prices and they always want better quality. So I'm actually like kind of hoping they'll drop it a bit. Obviously, it will hit profitability a bit, but I don't really mind that if it retains more customers and also it gives the customer a better customer experience, right? So average spend from customers is flat year over year. This is a good thing and a bad thing because you don't want, as a drug company, for your consumers to be spending too much money on your platform, right? Because eventually, obviously, a lot of companies think the more you spend, the better. But this is not like I don't want this to become one of those companies that is like, oh, even you have a minor problem that doesn't need a drug to solve, let's sell you a drug. So that kind of company will really ruin the customer experience, right? So, and the last thing is they kind of dodged the free cash flow question in the conference call. I think some analysts asked like, what's the free cash flow estimates for 2024? And then they detoured from the 2024 and they gave a long-term free cash flow guidance, right? So valuation, that's only a slight red flag, but let's talk about valuation, right? So valuation is like 1 year payback period. Currently on all their marketing spend is like a 1 year payback period. I think that's phenomenal, right? Because usually companies would take more than 1 year to recoup, right? So if you think about it, every $100 they spend on marketing, they take 1 year to recoup it. And if it's only 1 year to recoup it, means you can deploy the $100 again, right? Means you can gain more customers. And then you take a look, it's 85% retention rate, right? If it was 50% retention rate, then obviously this 1 year payback period would matter much less, right? But you can see that 85% retention rate, so they spend $100, they get $100 back in a year, and $85 of that $100 next year they will retain again, right? So 83% gross margins. I already mentioned that this should go lower. Sorry, my WhatsApp is a bit. So assuming 100% free cash flow, right? Which I think it's easily, you can easily get there, right? So yeah. So I already explained this. It's at a 30x free cash flow rating, right? Basically, it's 27 times free cash flow right now. And I don't think that's a high estimate, right? That's a conservative estimate. So I don't think it's exactly very, very cheap. But if they continue to grow, then it is very cheap, right? Because if it's 27 times free cash flow, but they're growing at 30%, right? Next year is like 20 times free cash flow. If they can, and currently the whole market trades about 26 times earnings on the S&P. So I don't think this is like very, very expensive. But I don't think it's like the cheap, no-brainer kind of idea either, right? But with all that being said, another red flag, right, is that they are pumping the shares, right? Look at this. This was in 29th February, right? After the shares was up so much, right? So that is a red flag to me, right? Why is the CEO like talking about all this? I mean, it is possible that he's just like, oh, I agree, but this is a slight red flag to me, right? Because like, this post says that HIMS is a company with 100x potential, and I do even agree with this analysis, right? Because I did mention it was 100x potential from like somewhere here to my friends. I'm not sure whether I said it on YouTube, but to my friends I did mention that I think this stock could go 100x when it was around here. Right now maybe 50x potential if my initial thesis is still correct. But I don't enjoy like CEOs talking about this, right? Because I don't think CEOs should be talking about all this, right? When Elon Musk does it, I don't really like it either. So I don't think it's fair for people to school the ideas like this, right? Especially you will suck in a lot of the retail investors that don't really understand. Look, 29th of February, look, it pumped all the way up here. Maybe plus 28%, right? So I think around here, there will be a lot of retail investors that don't really understand the business that buy into the shares, right? And from a purely selfish perspective, they are the ones that cause all these crashes of 25% in 1 month, right? Because they buy in not knowing what's happening, and then after that they sell out and they lose money. That's bad for them. And then also the shares have higher volatility. I'm not complaining because I'm actually... So after all the analysis, I have to tell you guys that I'm adding shares, right? In fact, I bought yesterday somewhere around here. 12.45 was my buy order. So actually, I thought I had missed it, but luckily it dipped back. So in the coming days, if it goes down to 12.11, I'll still be adding, right? So what percentage of my portfolio is in HIMS right now is around 30-something%. So I did mention that it went all the way up to 80 over percent, right? And that's some crazy amount, right? Because I put around 40% of my portfolio in HIMS. So I don't really do small positions. So when I talk about shares on my YouTube channel, especially, I would have like quite a sizable position in it, right? So it's up to 30-something% right now. And after I trimmed it, right? So what happened was I had about 40% of my assets. It moved up to about 80-something%. I trimmed 60% of the position, right? Because actually I only wanted to sell about 40%, but then it ran all the way up here, and I thought maybe the run was overdue, and up to now I'm quite correct. So yeah, that's my analysis on HIMS, right? So currently it's around 27 times free cash flow, and I think the ROIC for this company will be quite high when they really like finalize the numbers, right? Because this company is not optimized for return on invested capital, right? But if you use back a 1 year payback period, then technically it's 100%, right? If they can do it long enough, right? So yeah, I think this is still for me a quite decent buy, a stock that I really understand quite well. So I wouldn't say it's the best opportunity out there. In fact, I don't think anybody can ever say it's like the best opportunity out there, right? Unless you find something which is trading at like 1% net asset value, right? Then that's a no-brainer, right? So yeah, that's about all I wanted to share in this video. If you did enjoy the video, do help me smash up the like button, hit subscribe, hit the bell button. With that being said, have a fantastic day ahead and peace out.